Hello, and welcome to the Business Behind Small Business, the show that reminds you that just because you own a business doesn't mean you're a business owner. In each episode, we will discuss a common issue small businesses face and offer tips and advice from the perspectives of two business owners, one that built to sell and one that built to inherit. We are your hosts, Sevana Stone and Chloe Lee. There's a lot of business behind small business, so let's get to it. So many business owners do not understand, don't get, that bookkeeping, accounting, and tax work are three very different fields, but all intersect. To keep it simple, bookkeeping is not accounting. Accounting involves bookkeeping, and bookkeeping leads to accounting, but they're not the same thing. In saying that, without knowing the basics, you won't know how much business you have, how much you lost, how much you can borrow or loan, and how much you should expect. Before we get into it, we should first address that there are three different basic types of accounting. There's cash, there's accrual, and tax accounting. Now, cash accounting accounts for revenue and expenses only when the money changes hands. Accrual accounting records revenue when it's earned and expenses when they're billed but not paid. Most small companies, when first starting out, will use cash accounting for real-time budgeting. However, as your company grows, you'll want to move forward with accrual accounting for long-term projections, budgeting, and to determine the true financial health of your business. Tax accounting is best left in the hands of a professional accountant. This form of accounting follows rules used to generate tax assets and liabilities, among other guidelines we're not going to dive too far into in this podcast. The terms we will refer to here will be focused for the most part to cash and accrual accounting terms. So, let's first identify what the most basic terms are. Know that what we're defining for you is found in your P&L, otherwise known as your profit and loss report, or your income or financial statement. This is important to note because so many people don't realize it's the same thing. This is only half of the view of your business's overall financial health. So, Chloe, if you would please share with our listeners your definitions.
Yeah, definitely. And if we have any listeners in the accounting and finance background, before you start rolling your eyes at what the definitions are, keep in mind that, we're really speaking to business owners who typically are not professional accountants. And so, our brains don't always work like one. There is just the point is just to get us as business owners kind of familiar with these terms so that when we do kind of dive into finer details, kind of like what you were saying, Sevana, whether it's cash basis, accrual basis, earned versus received, we can start layering down complexities on a solid foundation, right? So it's a little bit like going to school, people. You go to school to get familiar with the terminology, but let's admit, really understanding the context of any conversation in which those words are being used typically requires some experience. All right, so let's go into income. That is the word that everybody likes to hear. And in the very simplest terms, it means all the money that people give you. We all like making income. We know what that means. It is money coming in. Now, in income, there's two types. There is gross income and net income. And so gross, if you think about it, is sometimes you'll hear like top line. That's another word for it. It just means all of it. Everything you make, the full shebang that you've made, that you've charged somebody that they will eventually pay you. And then net is what's left over, essentially. So net income is usually your gross less some expenses, and then you'll get to your net income. So net is always net of something. So what's left over. So a few other terms tied to gross income and net income. So just kind of go into a little bit more detail about income itself. So income can be earned or received by a business due to the normal business activities. So sales of a good or some kind of service you're providing your client, these are usually considered business revenue. Now, some businesses may actually earn revenue from other sources like royalties, dividends, or interest paid to them from other companies. And the term revenue can also be used to describe a dollar amount that, again, is earned or received within a period of time. So, for example, sometimes you'll hear hey, so and so's business had, made like $100,000 last year. Most of the time, I think people, when they say that, they're usually saying their top line or their gross revenue, right? So it also sounds really good too. Right?
Yes, it does.
Yes, it does. Nobody ever tells you what their net is, but the gross always sounds really, really good. So getting to the net income side. So net is usually less some kind of business expense to get to the net income. So it's, like we had said, it's kind of what's left over. So a business expense is usually an expense that you, quote unquote, pay or incur in the normal course of your business. Now, Sevana, what about you? Some people have different definitions of what they consider normal course of business.
Yeah. Yep.
Because, when we talk about business expense, we usually think about expenses related to running our business and things you spend to actually generate your income. Mm-hmm. So I think one thing I think I've heard people ask before, and you may have too, Sevana, it's always about clothes and whether or not that's a business expense.
Yes. Mm-hmm. Yep, it is a slippery slope.
So let's just say clothes. Let's just take something that can actually be a business expense in one situation, but it's not a business expense in another company. So I chose steel-toe shoes as an example. I don't know, it's really random because I was trying to figure out something that works with two different companies. But let's just say you need to buy steel-toe shoes because you have a construction company and you need to buy it for your employees. Now, in a construction company, that's probably part of regulations to have, certain type of clothing. So that is an actual business expense because you run a construction company. Now, if you run an accounting company or a consulting company, steel-toe shoes aren't exactly needed for what you're doing. So in that sense, that is actually not a business expense for your company because, again, it's not part of your normal course of business, or it's not required as part of your normal course of business. So in that sense, that's like an example of one thing that could be an expense for one company and not for another. In other words, that amazing business suit that you bought to go to networking events, not a business expense. Sevana, have you ever heard that before?
Yes.
I've seen, I think I've heard a lot of people trying to expense their clothing. And it's like, try.
Yeah. It's a question. I think it helps to ask the question, is this something that will benefit my company? Not, is this something that will benefit me? Because then you will look at those beautiful shoes and be like, oh, maybe this benefits me and not my company. So that's the question you always have to ask yourself, and that kind of helps. But I've definitely come across people who are like half of their expenses really are not business expenses.
Yeah, and the thing is, like, as business owners, we're probably not doing ourselves any favors by flooding our profit and loss report with, expenses that really has nothing to do with generating an income, right? So for most people, they argue this point because they're thinking about tax accounting and they want to, get away with as much expenses as possible so they can kind of pay less taxes at the end of the day. And that's certainly something you can try to include in there. But, at the end of the day, I still think that we're not doing ourselves any favors by not having accurate financial reports because, we're trying to get all these expenses in there that really has nothing to do with the business itself.
Yeah, and I think on the flip side of that, if you are maybe in the next couple of years looking to get a loan for something, maybe buy a house or whatever, if your income is so low, you might not qualify. So it's not really a good, I guess, direction to go in to try and expense literally everything so that you have minimal income in order to pay less taxes.
Well, that kind of goes back to what you were saying, is that difference between cash, accrual, and tax accounting. It all kind of comes to mind, like very different financial reports. But you bring up a good point too. Who's going to look at your financial reports? So certainly, when I was selling my business, absolutely the buyer went through my financial reports with a fine-tooth comb, and I'm sure it would have not come across well if I had a big account for all the clothing that I was expensing because of all the workflows I had to buy for my business, or just for myself to be present in my business. So, same thing like you were saying, if you're going to the bank to get a loan or whatnot, your bank will go through your books to see this, and if your bottom line doesn't look well and they're looking at your details and they see that you're adding all these unnecessary expenses, they're probably going to question a little bit whether or not your financial reports are accurate.
Right.
Yeah.
Right. So, thank you for sharing that, because I think that that's very important. The revenue, the income, the profit, the loss, I think all of those sometimes can be lost on a business owner, and they always look at the bottom line, which is not really the line that you should really, really be paying attention to, which is why we are sharing these definitions with everyone. So we've got the basic framework for the P&L, but now we're going to move on to the balance sheet. Now that's the other half of your business's overall financial health. The P&L shows the actual in and outs on a daily basis, the bank transactions. The balance sheet will show your long-term losses and gains. So what's a balance sheet? A balance sheet is a statement of the company's financial position shown in terms of assets, liabilities, ownership equity for a specific period of time. You'll often hear the balance sheet referred to as a snapshot of the company's financial position, or just financial position. The difference between the total assets and total liabilities is known as the company's equity, or its net worth. Everyone's familiar with the word net worth, so that's what net worth is. Basic accounting rules tell us that a company's net worth must be equal to the assets minus the liabilities. It's important to note that in accrual-based accounting, accrued expenses are recorded within the current liabilities of a balance sheet. Accrued revenue would be recorded within the current assets section of the balance sheet. Both tend to be considered short-term, meaning you're going to get paid or going to pay something in a short period of time. So, what are the words coming out of my mouth?
I was going to ask you the exact same question. That sounds like a lot of terms, and also a college course.
I totally agree. So, when you as a business owner are sitting there with your bookkeeper or your accountant or even your CPA, and they are reviewing liabilities with you, you need to understand what your liabilities and assets are, because that's very, very important. Profit and loss refers to things that are happening on a day-to-day basis, but liabilities and assets are those long terms. So a liability of a business is an obligation that came from a prior transaction done by the business. A liability is assigned a monetary value, and the business is responsible for repaying that amount in some way in the future. So accounts payable, wages payable, loans payable, income tax payable, anything payable.
Basically money that you need to pay somebody else.
Exactly. So those are liabilities. That's not money that belongs to you. That's not money that you earned. That's money that you have to pay. Asset are any items that are owned by the business that's expected to last several years. So like a company car, office furniture, computer equipment. If you're going to lease or rent property to tenants, it can include rental houses or improvements made to the business's property. General office supplies, they're not considered assets of the business, but they can be listed as a qualified business expense for tax deductions. Of course, there are more drill down details to discuss, such as cash and investments, prepaid expenses, loans, common stock, etc., etc. However, we'll be discussing deeper in our next episode, and we'll only give an overview here for the sake of time.
Yeah, so I think if we kind of break it down really simply, is if we think about the profit and loss, it's really two items. It's revenue and expense. Luckily, the profit and loss is the most popular financial statement, and it's the one that everybody wants to look at first, because everybody wants to go to that bottom line to see what happened. Are they in the red, the black? And then the balance sheet, I think overall there's only three sections you just need to know that there exist. It's the assets, the liabilities, and then equity. And then everything falls within those 5 categories on the 2 financial statements.
Mm-hmm.
So that being said, there are a couple other items on the balance sheet, words that will be just important for you as a business owner to know. So let's start with accounts receivable. So accounts receivable is you see what's due to you, right? So this is money that most likely in practical terms, what people think of when you invoice your customer, and most people give your customers a few days to pay. And so when you invoice them, you basically have an accounts receivable. So it's the money that your customer owes to you. And that's considered a current asset on your balance sheet. Mm-hmm. For accounts payable, which is kind of on the flip side, accounts receivable, accounts payable is on the current liability of your balance sheet. So this is essentially money that you owe to someone else. So it could be a supplier, it could be a vendor, it could be a creditor. Accounts payable itself, let's say if a vendor invoices you or bills you for work they did for you, let's just say that maybe say you hired a contractor or somebody like that, then usually their bill will show up on your accounts payable, and this is something that is essentially you know that you owe out of your company, money going out of your company at some point. Now, there's also the owner's equity. So this is kind of falls into the third part of the balance sheet we had discussed. So owner's equity, sometimes it's called the book value of your company. This is what they say, I guess this gets into a little math. I guess the formula is usually assets minus liability will equal your equity. Mm-hmm. So let's just say, for example, what's a good thing for owner's equity is there's some nuances within the equity section, right? So it will include money that you invested in the business to get it started. So usually this doesn't come from your business itself. Usually maybe if you're starting up a company, you have to put some money in the bank to kind of get things rolling. This also means you can continue to put money into the business, but usually it comes from something outside of the services you're providing to earn revenue. This is money that's coming from you. And it can also include in the equity, if maybe you have a partner that's also putting in money, they may also be carrying a balance on their equity section for all the money that they put in. Other things that might end up here is for some business owners, whether or not intentionally, unintentionally, sometimes you will use business funds to pay for personal items. So if you do that, usually those items show up under equity. This really gets it out of your profit and loss because, again, if this is business funds being spent on your personal expenses, it's technically not a business expense. So you wouldn't expect it to be on your profit and loss and skewing your bottom line. So this shows up in the equity section. And then another thing that you may see in the equity section is also retained earnings. So these are profits you earn from a business. So in other words, you know that bottom line that you have on your profit and loss? This basically gets carried over year, and it's added to the retained earning lines on your balance sheet. Still with us?
I can see it now. We were like, my head hurts. I don't want to hear anymore.
We may have to do some very hefty show notes for this one, just to kind of help lay it out a little bit more.
Absolutely. Because, these terms are very important. And what I guess inspired us before I move on to owner's draw, which is also, a hefty definition.
You want to get a cup of coffee, now would be the time.
Now would be the time. But what inspired us to do this is a conversation that we had about clients. Actually, we've had a few conversations about clients over the years that did not understand basic, and it's not to no fault of their own. It's a matter of, it was more a cause for concern than, oh, can you believe this person didn't know what this meant? No, it's it was more of a, unfortunately, my clients had no idea when I was saying P&L, I did not mean parts and labor. I meant profit and loss. Or another time when I had a conversation with a client about owner equity and owner draw, and it was a long conversation, and it wasn't until the very end where she very meekly said to me, I'm so sorry, and I know this is a really stupid question, but can you please remind me, what does owner draw and owner equity mean? And I get it. I've been there. I mean, when I first started out, very, very first started out, before I started my company, I had a hard time understanding what draw and equity meant as well when I started first doing bookkeeping. So they're not difficult concepts once you understand fully what the full scope of the word is. If somebody gave you one line of what it means, then yeah, it would take a minute for you to figure it out, but you'd still figure it out. But when you understand the full scope of what it really means, not just the definition, it helps you better understand where your company's financial health is headed or currently is.
Yeah, I agree with that wholeheartedly. I think it's just one of those, because accounting, it doesn't always seem logical. It probably isn't, to be quite honest. It's like a whole other language, I think, once you get into the accounting and whatnot. So it doesn't seem logical, but it has a beautiful outcome once you understand what it's trying to tell you.
Yeah.
At the end of the day, numbers don't lie. So if you're tracking your numbers correctly, no matter how well you think your company is doing in your mind, your numbers will tell you how well your company actually is doing. So it's a reality check, and it's a very good one. So I just a little bit farther down the road, I guess, if we're talking about businesses to inherit and then businesses to sell, certainly I feel like this might be the same for either case. But, when I got my business to a point where it was ready to sell, at that point, you are definitely a few levels removed from the actual day-to-day work, the actual deliverables to your clients. You may even have customers you don't speak to, and you have no idea they're even a customer aside from a name on the list that you have, right? So you are removed from your company. But if you know how to read your financial reports and you know how those numbers get to where they are, you can easily hone in on any issues that you may have in your company by just simply reading your financial reports.
So and understanding what those words mean. And you're reading your financial report, but you're understanding what those words mean, because in the end, you shouldn't be relying on your bookkeeper or your accountant or your CPA to tell you when there's something awry, which is something we're going to talk about in our next podcast. But you shouldn't be relying on them to tell you when something has gone awry. You should have the onus of you should be taking over. Bless you. My dog just sneezed. But you should be taking onus of your own company's direction. And so that's where we're coming from.
Well, the buck stops at us, right?
Totally.
On top. And so, literally.
Yeah.
Read the report that tells us where our bucks are.
Absolutely. And in speaking of which, owner's draw. Now, owner's draw, I find to also be a slippery slope. So owner's draw
means the
whole
section of equity is typically a very slippery slope. One of the most important sections of the entire financial report, all the financial reports, and yet also least the hardest to understand.
Yes, I agree. It's the most important and the easiest to manipulate, and it's almost like if you were to build your home on sticks. If you use the right sticks and you do it right and you lay them all correctly, you could probably build a sufficient home. But if not, the whole thing will fall apart, and it all starts with equity. So owner's draw. Owner's draw is the withdrawal of a sole proprietor's cash or other assets for the personal use of the owner. So owner's draw tends to be, an example of that is when you're pulling money out of the business account for your personal use, meaning to pay yourself. If you need to pay yourself, or let's say you need to take some extra cash for something else that's personally involves you personally, may it be meal, gas, grocery, whatever, you're pulling it out of the business account, putting it into your personal account, and then using it from there. The owner's draws, they're not reported as expenses. It's not an expense on the income statement of the sole proprietorship, but rather the owner's draws are considered to be a direct reduction of capital and equity.
Well, so I think one of the things I just wanted to point out here is for those who are listening, they may not be picking on the fact that you're saying owner's draw. So owner's draw is different than owner's distribution.
Yes.
So you're speaking to a very specific type of account that accumulates the information of what is being taken out of the company for personal use. And you did mention the fact that this is for sole proprietors.
Yes.
So
yeah.
But depending what entity you are, you may end up incurring owner's distributions instead in the same fashion, but it also has very different tax implications. So I wanted to point that distinction out for those who are probably just thinking if they have a S Corp or a C Corp or something along those lines.
Yes, absolutely. Yeah. So I'll reiterate that the owner draw is very important. I'm focusing this statement on sole proprietors because especially if you are if you're in business for yourself, you have to pay yourself, right? Your business and you are two separate things, and you do have to pay yourself, and you're not going to be on a payroll, so you're going to pull money out for your own personal use. But this is where the slippery slope comes in, because you're pulling out money to pay yourself, but then you're like, I'm just going to pay myself to take myself out to lunch, and then I'm going to pay myself to pay for my groceries. You inadvertently start to use your business as a bank, which is red flag, red flag, red flag. Like, I can't even tell you how important it is for you to know that you cannot, under any circumstances, use your business as a bank. You and your business, you're not the same. You're not the same entity. You are different and your company is different. You're not together. All business transactions should be held separately from personal transactions, and they should take place in their own account. This is what we call commingling of accounts or commingling of funds. A lot of sole proprietors will find themselves falling into that trap, but I've seen it done with much, much larger companies where commingling has happened, maybe not at the same rate. Talk about a red flag. You want the IRS coming breathing down your throat. That's one way to do it.
I'm pretty sure your CPA will also really hate you.
For sure.
Right. I think you're absolutely right. I think there are companies who are probably a little too large to be doing this, and they're still doing this. At the end of the day, what you say is true, is you absolutely have to treat your business like it is a business, and it is separate from you. Do not treat it like it is your personal bank. Second to that is also just depending on the size of business you have and a type of business, oftentimes there are different ways of getting money out of your business for your use. You just got to do it the right way. And again, a great accountant or a great CPA should be able to advise you on how to do that. It just seems that for owner's draw, when you're a sole proprietor, that just seems like the easiest thing to do and most likely like the most common violation that's happened. But it's also it's not good. It doesn't look good. It's not good. And when you have this going through your financial reports, people see it and they immediately question whether or not you're running your business like it's a business.
Absolutely. So we've said the names of all of these things. We've given you the definitions of all of these things that you're going to find on your profit and loss report, that you're going to find on your balance sheet. However, how are those numbers going to show up there? Where are they? Where are they coming from?
Where do you find them?
How do I? Yes, we shall write you out a map, and you shall go find the eggs. So this is how you would find those numbers. Let's say I'm going to use QuickBooks for example, because I find that a lot of people use QuickBooks. But if you used something else, like say Xero or whatever other bookkeeping platform either your company is, or rather if you are using, or if you have hired a bookkeeping company or an accounting company, whatever. In any case, every month accounts should be reconciled. So the bank, credit card, any financial institution that you're using that receives and takes and spends, transactions exists in, this should be compared to the information that you have in, I'm going to say, QuickBooks. After all of the transactions have been compared and checked off, the balance will then be zero. This is considered a reconciliation of an account, and you have a reconciliation report, and it's the only way to have the accurate data for any kind of report that you're going to look for. May it be a profit and loss, may it be a balance sheet, may it be any other cash flow projection, whatever kind of report you're doing. You have to reconcile the books first. Mind you, not you, but somebody has to be. Preferably
if you have a bookkeeper or you have an accountant or a CPA working, I think one, let's hope they're reconciling the bank and credit card accounts. I mean, because if you think about it in that phrase, right, like everything for your business, whether it's money coming in or money going out, will always go through either your bank or credit card account, right? Mm-hmm. But there are the other accounts on the balance sheets that we've mentioned. There's the accounts receivable, accounts payable. There are other types of liability and asset accounts that ideally your accountant should also be reconciling on a very frequent basis to ensure those accounts are also accurate. But the number one starting place is usually your bank account. Again, because that kind of tracks everything going in and out. And then you layer on the accounts receivable, the accounts payable, and then that'll give you kind of the full picture. But if you do not start with that reconciliation, then most likely everything will go down south. And I promise you, every accountant will say that the number one thing they do is they first reconcile the bank and credit card accounts before they do anything else. So if you're doing your books on your own, that's probably what you should do too. If you're hiring somebody else to do it, let's hope they understand what you're saying to them.
Absolutely.
If not, be worried.
Absolutely. And I will add to that I feel like the day that you start your company's bank account is the day you should start hiring or looking into hiring a bookkeeper. I truly, in my heart of hearts, truly believe that even though I have in my garage right now, there are, I don't know, maybe 10 hammers. There's probably upwards of 30 different types of screwdrivers. There's all kinds of wrenches and everything. Can I build a car? Absolutely not. Can I build a house? Absolutely not. Do I have the tools to do such? Absolutely I do. I feel the same way about service platforms. When you have something as elusive and enticing as, say, QuickBooks, it leads you to believe that you can be the number one bookkeeper of the world. However, it's not built for that. It is a platform. It is a tool that someone who actually knows how to do it should be using.
That's a very fair statement.
Yeah. So
actually, I didn't know where you were going with that. I thought for a second you were going to say you have 15 accounts in your garage, and I'm like, oh, okay.
Oh, okay. Cool. Well, in any case, so we are now going to go into our famous examples. So we like to use a famous example or a popular example that ties into what we're talking about so that you have a broader view of what we've just discussed. Because we can speak for ourselves and in our teeny tiny worlds, but that doesn't necessarily mean that you can identify with us. But if we give you a big world example, a famous example, perhaps that will then connect you to what we were just talking about. All right, so I am going to share two of my famous examples. And this is the part that always makes me so giddy because I love history. And I'm going to take it back to these two amazing stories of the importance of knowing accounting terms. One ended amazingly well, and the other, well, that went well, but not for him. In both cases, both of their stories were forecasted by the power of accounting. So many people, I'm sorry, I'm so cheesy. Anyway,
I love it. Let's talk more in that voice.
I know. So many people are familiar with Al Capone and his incredible reign in Chicago during the 20s and 30s. But few know that it wasn't his racketeering, murder, bootlegging that brought him down. Oh, no. It was his unpaid taxes. I giggle all the time when I think about this. A team of accountants that were led by Frank J. Wilson. He's the father of forensic accounting. He was also one of the untouchables. He combed through Al Capone's books, and it took over 2 years, 2 million documents, and they broke the case and discovered 3 ledgers that ultimately led to Capone being indicted on 23 counts of tax evasion. This guy, Al Capone, just could not he was untouchable himself. They could not bring him down for anything else. And Frank J. Wilson thought, I'm going to figure this out. There's got to be something we can bring him in on. And that was what ultimately led to Capone going to prison. Now, on the other side of the value of good accounting is Ruth Handler. You may not recognize that name, but to me, she is single-handedly the most famous and influential woman of both the 20th and 21st century. Her husband had an incredible eye for art, but not so much for business. Ruth, however, knew money. Ruth and her husband Elliot and their two children, Barbara and Ken, worked like a team. Elliot was the creative, and Ruth grew a business based on projections and estimations and her keen business sense. Like, she knew when things were going to be popular well before they became popular. Within 25 years, her company, Mattel Creations, was a multi-million dollar company. Get it? Barbie and Ken?
Cute.
Yeah. When she was diagnosed with breast cancer, she decided to get into the prosthetic breast business again through projecting and estimating, and grew and grew and grew. Her shrewd business tactics and keen sense of books created a toy company that's still making a profit 77 years later. Insanity.
That's amazing.
So Ruth Handler, which, again, you may not recognize that name, but she is the genius behind Barbie, and Mattel was a combination of two names, Matt something, and Elliot, Matt L. I can't remember Matt because that was before, and Mattel ended up, Matt from Mattel sold his share, and Mattel Creations went on to the stratosphere from there. So
wow, that's amazing.
Yeah, both great examples of great accounting. So in moving from there, we like to also make some recommendations on either books or apps or platforms or any other kind of recommendations that we can make for you so that you can take from this and hopefully exercise it in your real life. So for me, I'm going to recommend the book Dream Doll. It's the Ruth Handler story, and it was written by Ruth Handler herself. She was an incredible businesswoman and truly understood the business behind small business. I also recommend, if you're not big on books, to listen to episode 116 from the History Chicks podcast, which is all about Barbie, but it really dives deep into Ruth and her husband Elliot because there's so much more to it than what I told you. It really is incredible the way her shrewd business sense. As for tools, accounting.com has a host of resources for small businesses. I also recommend checking out your local SBA for workshops focused on accounting or bookkeeping for your company. Lastly, you must invest in a good bookkeeper. Not only will they keep your books clean, but you should be able to talk to them about anything you don't understand. They're your best source for learning terms and better understanding your company's finances. And like I said before, don't come at me with QuickBooks. It's a tool. It is a tool. It is not the professional.
As much as they, like, Intuit tries to advertise them like, oh, this is almost like the books will keep themselves. It's
absolutely
does not replace the person. So.
No. And I have said this more often than not. I always say that QuickBooks is set up like Indiana Jones. You think you're doing great. Everything's going well. You're headed towards that gilded cup. And then all of a sudden a boulder comes trying to kill you. That's how QuickBooks is set up.
Well, that's usually what happens when you're frantically also looking for the person to fix it all.
I know, exactly. So you need to go with a professional, hire a professional. All right,
agree more. All right, so I have a book recommendation myself. One of the episodes we did talk about Vern Harnish. He has this book Scaling Up. There's a great chapter in there, the book's in 4 quadrants, so a quarter of the book is focused on scaling up cash. And it covers the basics of accounting, but even better, it covers how to actually use the accounting to your advantage as a business owner. So it's just one of those great practical application types of books, and that chapter is really, really, there's a lot of gold in that chapter. So
that's a fantastic book,
right? Yeah, I know. I have to keep bringing it out, and it's such a heavy book to read, only because every page has so much great information that I literally need to stop and think about it for a week every time I read.
I agree. I did too.
And then go reread it the following week. Like you were saying, so accounting systems, again, pretty much what they have set up these days, makes it very user-friendly. So whether you're talking about QuickBooks Online, FreshBooks, Xero, Intact, all those stuff, they set it up for the non-accounting user so you can kind of keep up with yourself. And I'm not recommending that you do it yourself, but they do have some videos in there, and sometimes it does kind of help to look at the videos and figure out kind of like help you connect the dots between some of the terms we were saying, where it falls, and what kind of goes into the accounting system to get the financial reports looking the way it does. Mm-hmm. But if you do not have an accounting background, then maybe it's best that you leave it to the professionals. Mm-hmm. And then, of course, on the other end of that is also like YouTube. So, again, it's a wealth of information on there that will teach you about the basic accountings for small business owners. Mm-hmm. So, last but not least is kind of reiterating kind of what Sevana was saying. Definitely use your bookkeeper and your accountant as references. Learn from them, ask them questions. There is a logic to how accounting works. So, if you look at your financial reports and it doesn't make sense to you as a business owner, absolutely ask why and have your bookkeeper or your accountant explain it to you until you understand. Don't feel intimidated just because there are a lot of terms that you don't know. It is your business and you know your business best. So these reports need to make sense to you. Now, of course, you may have to pay a little extra for this education on the side because this is in addition to what your bookkeeper and your accountant probably actually does with the actual accounting work. But regardless of which, that education is always going to come out cheaper than you having gone off and gotten an MBA somewhere. Mm-hmm. This is foundational knowledge that you have to learn. And I think I've seen this time and time again. Sevana, I'm sure you've seen this. If you keep kicking the can down the road as your business gets bigger and more complicated, this will come back to bite you.
This is definitely one of those situations where you have to spend money in order to make money.
Yes, and it's better to learn when things are smaller and more simpler. Mm-hmm. But even if you are of a decent size, or maybe you're just a little under $1 million or something like mm-hmm. that, that's still a great time to actually learn this. Yep. But it wouldn't be the first time that I've run into a company where they're in the tens of millions, and admittedly, the owners, the partners who started the business are just now learning how to really read the balance sheet and the financial reports. So mm-hmm. it will always come back around. So don't kick the can down the road too long.
And just one quick comment on your suggestion of YouTube. I will say that it's also good to utilize YouTube to help you understand maybe what your accountant or your CPA or your bookkeeper has said to you. Maybe they want to have a discussion about something and you're like, I really don't understand what they were talking about, or I don't really understand what they're going to talk about. You could go to YouTube and just Google it and look it up to at least have a better understanding of what the conversation is going to be about.
Absolutely.
Yep. So please join us for our next episode. Your business is in a financial crisis. Or is it? How would you know? We're going to discuss red flags on your financial statement and what to look for. Much of what we're going to discuss is going to tie into the definitions that we discussed in this podcast. So hope you tune in. Want to ask a question? Leave a comment or become a sponsor for a future episode of The Business Behind Small Business? Click on the link in the show notes and fill out the form. Until next time, thanks.